Hey guys, welcome back to the Real Estate Monopoly. My name is Kerwin Donis. My brothers and I, we've been traveling for the past few weeks, so it's just awesome to be back home. And yeah, of course, we love going to real estate events and things like that, but it's good to be home and just be chilling. And we also get to talk to amazing guests like today's guest. Eli, thanks so much for being here.
Man, it is very exciting. We're heading into a long holiday weekend, so this will be a great wrap up, man. I'm very pumped. Thank you.
Yes, sir. I know. You're always busy. What's new with you? Any exciting life updates with the audience before we give them a little background on you?
Life updates. Well, we got back from Cancun just a week or two ago. So if you can notice my amazing tan, no, I'm
Nice,
just,
man.
no,
I
we
see
did,
it when
but
you're glowing.
yeah, no, it's actually kind of a working vacation because we're under contract on our first Texas deal. So we're under
Nice.
contract on a 200 plus unit in Lubbock, Texas. So it was a good vacation, but we were still every morning up, and raising capital. So it
Yeah,
was
no,
good.
that's awesome. The background you sent me is outdated then, but that's awesome because I guess that
Oh,
was clear. No worries. But before we get into the good stuff, let's just dive into your background real quick. Eli is a retired veteran where he proudly served his country for 21 years as a paratrooper in the U.S. Army, and he later as an IT specialist in the U.S. Air Force. He co-founded the Atlas Multifamily Group, and he also has partners. Their names are Chris and Nathan, and they are Texas-based syndicators who own and operate, I believe it's probably over $44 million in assets under management right now. And they are currently invested in Arkansas, Oklahoma, Kansas, and now Texas. To help others build wealth and grow professionally, Eli co-authored a book with other high achievers, and that is an Amazon bestseller. And he's also a co-host of the Real Estate MF Guys show. I'm assuming that's multifamily, not the other MF. But I love the name.
interpretation.
Yeah, exactly. No, exactly. I love the name. I like the show too. I did watch, got a chance to listen to some episodes, and I know you guys are very busy, so I appreciate you being here today.
Yeah, absolutely, man. Yeah, thanks. Yeah, so I'm prime military. Spent 21 years in. I started out in the Army. I got out, went to school for about 2 years, and then I joined the Air Force where I finished my degree in business. And it's about 15 years into my my military career where I kind of turned to my wife and I was like, hey, we need some extra income coming in to where when I retire in the next 5 years to replace this income, right? And so about that time frame, we started buying up houses, just like little small rentals, and we did pretty good with them for a couple of years. But then we kind of realized, okay, well, at this pace, we're not going to be able to meet our goals, right? So about 2017, I started networking and so to back up a little bit, about 2017, I remember driving around town and I saw an apartment complex and I was like, man, who owns those things? Like that'd be way more efficient to own,
Yeah.
like 100 units under like one roof where they have like 30, 40 houses spread across town. So about that time frame, we started kind of networking and learning, how do you buy these things, how they structured, who buys them and all that. And about 2018, I joined a mentorship group, and that's where, like that first year, I picked up like 320 units in Atlanta. There's like two different deals. Those went full cycle. We held those for about 2.5, 3 years, sold them at the end of last year. And then about 2019, I met my two partners that you mentioned, Chris and Nate.
Mhm.
And yeah, so now we own about 815 units across Arkansas, Oklahoma, and Kansas. And not so we're starting, so once we close in Texas, like about
Yes.
next month, we'll be just north of 1,000. So
Nice. That's exciting, man. I love to hear it. I love to hear it.
yeah.
And you mentioned that you were in the military, and I think you kind of quickly went over it, but you started investing while you were deployed. Is that right?
Well, I started investing. I was
Like in
stateside.
multifamily.
Oh yeah, and well, I started learning about
Okay.
multifamily. So about 2017, when I started kind of doing the transition into multifamily, I deployed that year to
Hmm.
Kuwait. That same year, I met the owner of Think Multifamily. His name is Mark Kenny.
Yep.
And so back then he didn't have a group. It was kind of like just me and him, and he would teach me one-on-one. And so I was deployed overseas. So I'd wake up about 3 or 4 in the morning and I would jump on a phone call, which was nighttime here, and he would mentor me. And then I'd go do my duties, and then I would get off and I'd jump on a phone call again with him at nighttime because it was daytime here. And we did that for about 6 months until so. And then at that same time, he also would send me like videos
Mhm.
and materials that I would edit for him, and kind of give him feedback and say, hey, no, this doesn't work. Add this, take out this, take like this kind of angle or whatever, and to help him build his program too. And then when I came
Yeah.
back, then he launched Think Multifamily, and I was like the first one in this group.
Yeah, no, that's awesome. You're like the OG. We always call you like the original one because my brothers and
Yeah.
I, just for context, we're partners. We're members of the group, and we really like the group. But yeah, I know that you come from a military background. The reason I think that's so interesting is because you probably have a different perspective on investing, or maybe a unique perspective or approach to it. So how has that like military background impacted your investing? And do you have any kind of key takeaways, or I guess lessons that the military taught you that you now apply to real estate investing?
Yeah, there's tons of, lessons and mindsets. I was, to be honest with you, I was kind of getting burned out like my last few years when I was in the military, like, as I was growing, from 2015, 2014, and so on, as I was kind of shifting my mindset into like more of like a wealth building mindset, right? Like a real estate mindset. I kind of realized like most people, in the government and in the military, they kind of have a fixed thought process, right? Where like they're going to come in, work for the government for 20, 30 years, regardless if they like it or not, with the idea that they're going to retire one day with a pension and be on a beach, happy on a beach one day, right? And so whenever I was in that phase, I was like, man, this isn't me anymore, And so over time, I kind of became like a black sheep, because I would come in talking about personal growth and buying multi-million dollar apartments, and or even buying houses, and they were like, well, that's for somebody else, that's not a real thing for for guys like us, right? So um it was interesting, seeing how very
Yeah.
different my day was. So like in my daytime, I had to think one way, and then at nighttime when I go to build my business, it was completely different, right? It's a completely different mindset. But I will say the military is super helpful with discipline, right? So I've been in all kinds of horrible environments, right? Like training, and where you're sleeping in swamps, you're trekking through snow, a lot of hardships, right? You're in a jungle, you're deployed overseas, so you're alone, so you have to overcome a lot of adversity, a lot of stress and things like that, right? So you can apply that very easily to what we do here. Cause like I know on Facebook and social media and Instagram, it's all sexy and fun and everyone's all happy, but really like our day to day is pretty stressful, right? It's monotonous at times. It's it's very challenging, right? So if you have the right mindset and discipline to drudge through, right, and keep going regardless, if you get 1 inch one day, or or you step back a foot the next day, right, you have to overcome adversity. So that's one way,
Yeah.
or two different ways like the military has impacted my mindset at least.
No, that's awesome, and I completely agree. I mean, thank you for your service. That's really awesome that you
Oh,
did
of
that,
course.
and it's really interesting that uh, you say it's the mindset in terms of the adversity, because I can't agree with it. I can't like relate to the military side of things. But when it comes to investing, yes, absolutely. There's days where I have to be very courageous, and there's uncertainty when you're
Oh
investing, and
yeah.
like you don't know what's going to happen. You're very stressed out and nervous, and it's just kind of crazy. But it's all good. It all ends up working out, and so kind of to touch on the courage side of things. um, a lot of people might see investing in this kind of current economy as courageous. And I'd love to know, I mean, is that how you see it? Or how are you feeling about investing in this current climate and this economic, I guess, do you see it as economic uncertainty, or what's your 2 cents on that?
There's always uncertainty. There's always volatility. Um, like a lot of the deals that we bought, like we bought 400 plus units back in the middle of the pandemic, like right when, like in March of 2020, right when it kicked off, we were under contract. And so that was a very uncertain, like climate back then too, right? And we didn't buy it back in '08, but I'm assuming that was the same way, right? So there's always uncertainty, but what I've kind of learned, back in the pandemic, and even now, is that it goes back to Warren Buffett saying that, be fearful when others are greedy, and greedy when others are fearful. Because what we learned back in 2020 was that we only got those deals because a lot of the players who were competing for like those those deals, they gave up and pulled out. They were like, "Oh, this is uncertain. We're done." And it was challenging. It was, man, because like lending was, volatile. It was crazy, and every day, like they would change the terms on you, or like they would, add new challenges, add new reserves, or whatever, right? And so, the whole environment was kind of topsy turvy. But what I realized was, those who have the grit to stick it out and get to like those challenges and obstacles and overcome them, those guys are the ones who build wealth, right? So we had to retrade, we had to give up some stuff too, right? But those deals are killer deals now. And so it's the same way today. And so
Mhm.
I've learned that, those who are able to maintain a rational mindset, um, and keep looking for deals, good deals, regardless if the market's up or down or sideways, those guys win, right? Because like the people who control real assets like real estate, gold, commodities, energy, those are the ones who build and maintain their wealth, whether or not the market's good or bad. They do.
Yeah.
It's just how it's worked historically.
Absolutely. We were at the MFIN Con this past weekend, which was an awesome event. And one of my
Okay.
favorite questions to ask people was, what do you see coming? Like, what's your perspective on it? How are you feeling about whatever's coming? Because as a new investor, I haven't been through an economic downturn, right? So I was trying to ask people that have been, and maybe that have more experience in this industry. And well, the thing that a recurring theme out of a lot of people's responses was that they saw opportunity coming. And that's how we like to see it. I like how you mentioned that there's the opportunity where people are greedy, be fearful, and fearful when people are greedy. So right now, I would say maybe the tides are turning and people are starting to be more fearful. And so I do see a lot of opportunity coming. And I don't know if you've ever heard this, but a lot of times people say during times of economic downturns and hardship, that's when the greatest wealth transfers happen. And so that's just like I kind of interpret that as wealth is real estate. And so if someone's selling their real estate, I'm here to buy it. That's a transfer. So
Yeah. I mean, deals are they're harder to find, like good deals. I mean,
mhm,
there's tons of deals out there, right? Look, regardless if the market's up or down, there's tons of deals out there, but good ones are harder to find in a downturn. But so you just have to look harder,
yeah,
right? But I mean, people, it shocks me when I hear people, going pencils down, and I'm doing quotes for those who aren't watching this,
yeah,
but I'm going pencils down, or like they tell me, yeah, I'm going to pull out. It's in the sidelines. And I'm like, for how long?
mhm,
Like the guys who set out in 2020 for a year, that was a year of missed opportunity. Now they missed a lot of bad deals too, right? But
mhm,
now their money's been sitting in a bank or sitting, I don't know, like in their safe or wherever it's been sitting,
yeah,
losing value, to inflation. And I'm like, so what are your options? Are you gonna, you know, get fearful and pull out to the sidelines to maintain some kind of like false wealth? Like that doesn't make any, you have to overcome, like
yep.
that mindset and go out and still hunt down deals.
Absolutely. I like how you said pencils down. We always make fun of Kenneth because he'll be like pencils down on the deal. And like he's always
Oh,
saying
okay.
it when no, but like I get what you're saying because people might say pencils down is in terms of like they're not underwriting right now. But when Kenny says it, he says it like pencils down on this deal. It is just like it's like almost like he's a broken record at this point. Like pencils down, we'll mock him now.
Oh, that's
It's
funny.
it.
I think I heard that term at, I
Yeah.
don't know, like at a conference or something like that. And
Yeah.
it kind of made me laugh. I was
Yeah.
like, pencils down. Okay. Yeah. We're going
100%,
to,
100%. And
uh,
so you obviously have a great portfolio, and I'd love to know kind of two sides of it because you guys are also on the acquisition side and currently looking for deals, right?
yeah. Yeah.
Okay,
Mhm.
so if you could kind of just give us a pulse on like what you're seeing right now, how are deals? You touched on it, but can you expand on what kind of deals are coming across? Are they more opportunities right now, or it's harder to find a deal? And also, what have you seen in the markets you're currently invested in with your current portfolio?
Okay. Yeah. So what kind of deals? So there's still deals out there. We focus mainly on 100 plus B and C assets. We have all three. So we have A's, B's, and C's. We have like one A class in Wichita, Kansas, in downtown.
Nice.
But mainly, so it's a really cool story. But mainly, we focus on just B's and C's, right? So they're still out there because people still have to sell and people still have to buy. Um, I would say it's more difficult because we're focusing more on on long-term debt now. So on this deal in Texas, we only got it because we underwrote for long-term Fannie Mae fixed agency debt, right? So which is lower leverage. So we had to lower our offer price. So like they asked for like 16.5 million, but we're like, hey, the environment's changing. You know, everyone else is still offering like these high leverage bridge debt terms. We're not doing that, you know. So that was like 2 months ago, you know, so long ago. That's like 2 months ago. We're doing current terms for agency debt, which is lower leverage and higher interest rates. And so we had to lower our offer. We said, hey, I know we're asking like 1.4 million under, but we're going to close. These other groups probably won't close because they're going to fall out once they realize the environment's changed.
Mm-hmm.
But so far, you know, and that's what when it's like that deal in Texas, right? So we got for a super cheap deal, but we have the certainty of closing, right? So that's kind of how we've been approaching our acquisitions, at least.
Nice. No, I love that. And I'm happy you touched on the debt. I do want to expand on that. But first, I did want to ask, in terms of like your market selection, are you guys currently invested in any, what somebody might consider a tertiary market right now?
Yeah, that's mainly like, you know,
Okay.
we invest in like outside markets. So we're
Mhm.
we're stationed out of DFW, which is a
Mhm.
primary market. This
Yep.
place is booming. Our deal in Texas isn't DFW; it's over in Lubbock. So about 5 hours, about 4.5, 5 hours from us, west of us.
Yeah.
Um, but that's kind of where we've always invested, is like on outside markets. We'll pick
Mhm.
markets that we can get like true value adds. Cause like here in DFW, I kind of feel like a lot of the deals have been traded like, you know, 3, 4, 5 times. And so they'll be like, yeah, just, you know, just add a backsplash and measurements by like $200. I'm like, it's not really how
Yeah.
rents work, you know, but we can go to a secondary or tertiary market like in Arkansas or, you know, Oklahoma, where, you know, some mom and pops owned it for, you know, 10, 15, 20 years, and they really haven't fixed it up. Right. So to us, like that's a true value add.
Yeah.
And we'll pick like cities that are kind of like hub cities, right? So like they might be smaller in population growth, but they support, you know, like they support other states, you know, like they support like the Midwest, they support the surrounding counties, they support the surrounding cities, because everyone has to go there for transportation, for travel, for um, um, if they want to open a business, if they want to do any kind of trade, if they want to go eat in town, they have to go there, right? So they have like a convergence of like highways, railways, airports, you know, that keep the economic climate alive.
Mhm. Absolutely. And we've heard a lot about Lubbock, Texas. Some of our friends that invest there. So I know that's a strong market. But in general, I've heard that like tertiary markets during an economic downturn, that's like a concern where they might not be as strong as maybe the main primary markets. But I think you did a good job of explaining like why you guys are confident that it'll be strong, even if something happens in the economy, right?
Yeah. I mean, the hub cities that we invest in, they also support a lot of like manufacturing.
Mhm.
And so that doesn't go away, or it doesn't go away nearly as much as like, so it's very uh, recession resilient, right? So
Yeah.
I mean, we have tons of factories, tons of blue collar jobs, lots of white collar jobs too, right? Um, but that all kind of works together during like a recession to keep like the market strong.
Yeah, no, I love that, man. And in the past, I've heard you use the phrase "defensible assumptions," and it sounds
Oh
like very,
yeah, yeah. That's
yeah.
Chris's term. Yeah.
Okay, you said it though. So
Oh, okay, I did.
I'm gonna ask you to expand on that when it comes to your underwriting, and like, how are you guys right now, especially? Are you guys doing anything different in your underwriting? And do you have any tips for underwriters right now? Like, how can they make sure? Because, like you said, there's a lot we don't know about the debt market and interest rates, like what the future of that is. So, how are you mitigating the potential for something like that to happen?
So when you first underwrite a deal, right, it's kind of a guessing game in a lot of ways. I mean, it's an educated guessing game, right? Because like you got your experience, you got your market knowledge, you got your numbers in front of you, right? But there's a lot of assumptions that you have to make initially on your initial underwrite, not when you're closing on the deal. It should be pretty clear cut by then, but like on your initial assumptions, you're kind of, using a combination of, your knowledge and others' knowledge, right? To make those numbers work. So what we mean by defensible assumptions is that as we move closer and closer to making our offer, we start reaching out to lenders, we start reaching out to contractors, we start reaching out to our property managers and saying, okay, this is what we've put in for these expenses. This is what we put in for income. Does our revenue make sense? Does the other income make sense? Does our business plan in general make sense for like this market? Because like we'll pick PMs, property managers that know the market and know our deal specifically. So, they may not have managed it, but they know our deal pretty well, and they know the market very well, so they'll say, oh yeah, you can add covered parking or you can add this, but I wouldn't do a dog park, because I for like this tenant base, it won't make any kind of sense, or this market won't do that. So we have to, as you kind of go through the process and you get closer to your offer, and even after your offer, after you do your due diligence and all that, you're constantly adjusting your numbers and figures to make them more accurate, right? So that's what we mean by our assumptions. Like we can back them up with like hey, these rent projections aren't made up by us. They've been vetted by several people who know what they're doing, including us.
Yeah, absolutely. And I think, like I mentioned earlier, a big part of that kind of uncertainty right now is the interest rates in the future of kind of where they'll land. And the Fed's actions recently had a major impact on the interest rates and kind of the debt that investors in general can take out. For people that may not be as like well versed when it comes to what's been going on, can you just provide some context as to what recently happened and maybe what you see potentially happening in the future, and tie that back into how that can impact real estate investors like you and I?
Yeah. So, for the last several years, the Fed's been, in order to prop up our economy, because of what happened during the pandemic, they locked everyone down. They put a bunch of policies that kind of stifled economic growth, right? So the Fed has a habit of overcorrecting, right? So they went into a time period of a quantitative easing, which means that they start printing money, trillions and trillions of dollars, right? And so for the last few years, they've been printing trillions of dollars to prop up the economy. And so that and on top of economic policies and different regulations, that's caused supply chain constraints. So all that added together has caused huge inflation, right? So of course now they recognize it. They didn't see it coming, I guess they claim. So they overcorrect because like they're always behind the times. They have outdated models, so they overcorrect. And so now they're going to do quantitative tightening, which means that they're gonna stop printing the money and start offloading like their balance books, right? So like they were buying $120 billion in securities and funds and not funds, but securities and bonds and all that. Now they're going to stop doing that, and their plan, so they claim, is to start selling back, right, on top of stop printing money, and lower interest rates. And so, and raise interest rates, right, to stop the inflation, which we're seeing today, right? Yeah. So that's causing, the markets to go crazy. It's in flux now. People are fearful. It's hard to predict where your interest rates are going to be, right? So we had underwrote our interest rates around between 4.5% and 5.5% on this deal, right? To make sure that, okay, well, they're I think like a month or two ago, it was like at 4%. But we said, okay, well, we'll start at 4.5%, right? We got terms back from Fannie at 4.4. But in a month, we think it'll be probably close to about, maybe mid to high fours, maybe fives or something like that, like 5%. So, but the 10-year, like this morning, was I think like at 2.9 or something. So who knows, man? It could be back at 3. You know what I mean?
Yeah.
But you have to use like those kind of assumptions, right? And say, okay, well, they're at 4 now. The Fed is doing like they're playing like their little games, right? That's messing up the economy. So we're going to go ahead and underwrite. We're going to stress test it to 4.5 to 5%, right? So that's kind of like our view.
Yeah, no, that's awesome, and I agree that's a concern. And can you just make sure, like, maybe expand on how that's impacting real estate investors, particularly in your scenario. Like, how does that impact your acquisitions, and just maybe
Okay.
touch on that? Yeah.
Yeah. So for sure. So for the last like few years, I think like 85 to 90% of a lot of the debt that people have been getting has been bridge debt, right? Because like it was long-term agency
Hmm.
debt, but then bridge debt became very, very competitive.
Yeah.
So bridge debt, it's not fixed. Oh, it can be fixed, but a lot of it wasn't fixed interest rates. So people were going out and getting this bridge debt to where like they would get like the short-term loan, stabilize the property, and then move, with the idea in about 2 or 3 years to move into fixed debt. So in an environment like this, that's pretty scary because now the Fed's changing the game, right? They're raising interest rates, markets are out of flux, lenders are freezing up. And so if you have a property that has bridge debt, now you're really watching it like, okay, well, shit, did I buy a rate cap? Like,
Yeah.
and if I didn't, are we at a place to where we can kind of weather the storm and wait it out? So you have to be very cognizant of, your business plan, where where you're at in the cycle with like your rehabs, how's your revenue doing? What's your lender's reaction to all these rate hikes? How's that impact your debt service, right? So that's one thing. The other thing also is it impacts your underwriting. So we probably would have gone out and got bridge debt like that, right? Like no problem. And we've talked to tons and tons of other syndicators who are still doing that. They're
Mhm.
completely comfortable and confident in bridge debt because like they have a different kind of game plan. They have different investor base, so like they're okay. But like we've had to alter our game plan, say, okay, well, if it's a deal makes sense, maybe, right? But we've seen a lot of uncertainty with our investors, right? So we've had to go out and you know, um, get long-term fixed debt, even though it's lower leverage, it gets us a
Yeah.
bigger raise, right? So now we're having to scramble to raise like, a lot more money, right? So I mean, like these things, like, you may think that, it doesn't impact
Mhm.
what we do in mainstream, but it absolutely does 100%.
Absolutely. And I'd love to know. I mean, right, particularly yesterday, I believe the crypto market is just going crazy, and stock market, it's just very volatile. All these other asset classes are very volatile. Just if you don't mind sharing, are you invested in any other asset class outside of real estate?
Yeah. I think crypto is so. I think it's the future, right?
Okay.
It's not going to go away. I'm not saying that it's going to be Ethereum
Yeah. Yeah.
or Bitcoin or whatever, but the fundamentals
Hmm.
are there, right?
Yeah.
Like it's hard to argue that the blockchain ledger is not going to be valuable. It'll be valuable in monetary policy, but it'll also um, transform a lot of other industries too, right?
Hmm.
Because it's peer to peer and secure and all that. Um, it's kind of the idea that back in the age of the 90s, people were laughing at the internet.
Yeah.
Back in like the late 1800s, like they were laughing at like bicycles, right?
Yeah.
And so, but the underlying technology, the fundamentals are sound. It makes sense. Now they were new back then, right? So
Hmm.
so we had to kind of get through a lot of bumps and changes, and alter things. But now, both of those and a lot of other things are rock and rolling. So yeah, I do have some crypto. Um, uh, I'm I'm big into gold,
Yeah.
like gold and silver, right?
Hmm.
And then real estate. Like I'm a big proponent of owning like real assets, right?
I love
So
that.
yeah, and then as our company grows and as our experience grows too, we don't want to stay in just multifamily. Like that's our base. Like we're good at multifamily, but once we hit a certain point, we're gonna start getting into other investments too.
Yeah, no, the reason I brought it up is because right now, particularly in the crypto market and maybe other investment vehicles, there's a lot of volatility. Whereas in multifamily, there might not be as much right now. So I would love it if you could maybe just from your own perspective, because I know you're not a financial advisor and you can't really
Yeah.
speak for everyone, everyone's experiences, but can you kind of just touch on like, how is the volatility in your other investments compared to your multifamily real estate portfolio?
Gold's maintaining.
Awesome.
My crypto's not doing so well, right? Uh, so this is what I did, right? So I kind of made like probably every 6 months or so, I make a little pie chart, right? So I take all my assets and all my cash, and I put it into like this little pie chart. I know it's probably pretty basic for most people, but sorry, I'm a dude, and then I like colors, right? So so I put in a pie chart, but it helps me get a visual on what percentage of my funds are tied up in different investments, right? So I can look at and say, okay, I've got 45% into real estate, I've got 25% into gold, I've got, and these are just made up numbers, right?
Mm-hmm.
I got 10% is into crypto, right? So these are numbers that I am comfortable with, right? Like, and also my cash, right? Like I don't want to hold too much cash, but I think it's important to hold on to some cash, right? Like, you should have a percentage that you are comfortable with holding on to cash. I wouldn't recommend a bank because banks can lock up your account, but that's me personally, right?
Mm-hmm.
But I have my cash in there, and then I also have other stuff like life insurance, like my infinite banking account and things like that, right? So it's all divided up. That way, whenever it goes up or down, I'm not for one, I know about it because because I keep track of everything. So it's not like it's a gray area where I'm like, oh, I wonder if it's going up or down, and now it's eating at me. And number two, it's a percentage that I'm willing to lose.
Yep.
Right. I don't think we're going to lose it, but if I did lose it, it's one that I came up with. I'm responsible for it.
Yep.
So I'm okay if it loses.
Yeah, and George Gammon talks a lot about that diversification and having like certain percentages in certain different investment vehicles. And so I think that's really similar to what you're talking about. And the diamond hands, right? You're not selling buy the dip.
Yeah.
When it comes to crypto, but
diamond hands, that's funny.
We have we could talk about that later, but no, we are interested in crypto at some point. We just I think maybe wait for it to get a little lower and then buy the dip, like I said. So we'll see. We'll see. Not investment.
I'm not sure what Bitcoin's at right now. I think I checked out last time. It was around like 30,000 or something, but I'm not sure where it's at.
I'm like, I'm honestly not very educated when it comes to crypto, which is why we stay in real estate, but we are interested in getting into crypto at some point.
I will say we're researching the tokenization of real estate. So I think it's still, man, that's going to be a game changer, but we aren't there. We haven't launched a fund yet. We don't have that kind of, we're just now in like the very infant initial stages of like, looking into, okay, well, how does that work? Like, how does it work legally? How do you structure it? Because it's a completely different game, SEC wise.
Yeah, no, absolutely. I know Michael Flight, he was a big thought leader when it comes to that in that space. And we've actually talked to him about that a few times. So that's exciting. And maybe when you guys do launch your fund, we could bring you back on and you guys can talk about that.
Yeah, absolutely.
Awesome. Well, we could talk for hours, but it is time for our speed round. Eli, are you ready?
I am ready.
Let's get into it. All right. Number one, what has been your biggest failure that you've encountered throughout your entire real estate journey? And what did you take away from that experience?
My biggest failure, man. Oh, there's so many. And I know everyone says that.
Me too.
They'll say that. Mine was probably on my very first deal, man. I failed in the race. Right. So like, I was very active on social media, and I'd go out to talk to people. And so I had my list of what I thought were investors, but I really didn't understand what it meant to, raise capital or to get people to like really know, like, and trust you. I didn't really understand like that concept. I mean, I was so focused on the acquisition. And so I didn't do well on my very first raise. And that was such a painful lesson for me because you're part of a team, right? And so your team expects you to be able to do certain functions, right? And so I kind of walked away with my tail between my legs. So that lesson taught me that, okay, well, I know what I'm doing. I know my numbers. I'm intelligent enough and I'm hardworking enough. so why can't, so why do I struggle with this? Right. So from that point on, I started focusing on more of marketing myself, putting myself out there in a way that draws people to me to where they can start understanding how I think,
Mhm.
like what my business plan is, what my game is, right? And then I can build long-term business relationships with them, right?
Yeah.
And friendships, right? And so because if they don't know, like, and trust you, they won't give you a dime, how good the deal is or whatever. But I was approaching it from a mindset of like, I was very transactional. I was a dude going there trying to shake hands and close deals. And I wasn't very emotionally intelligent.
Yeah.
So I've had to work very hard on shifting myself to be a better listener, to be more empathetic, and listen with compassion. Right.
Mhm.
And then to where I can understand my thoughts and emotions, but also yours. Right. Because if we can't make that connection, it's not going to work out, period. Right.
100%. And that's funny because honestly, like that's the opposite of my like interactions with you. You're very much like personable, and I've been able to like I think we've had some good conversations. And Jeffrey's always saying, "Oh, I
Yeah.
have awesome conversations with Eli." So that's funny. That's funny. You've come a long way, I guess.
Oh, well, thank you. I've worked on it, man. I wasn't always this way. So
Yeah, no,
thank
that's
you.
awesome, man. That's awesome. And so to kind of look to the future, what are you aiming to accomplish in your business more long term, and what are your goals moving forward?
Man, so I kind of touched on before. We're at the phase where, we're going to be 1,000 units once we close, on this deal in
Congrats,
Texas.
bro. That's awesome.
Yeah.
I love it. I love it.
Thanks. So we aren't small, but we aren't big, right? Like we know guys who buy thousands at a time, right? But
Hmm.
but we're definitely in a space where we're growing, right? So we're growing our business. We hired on a marketing director, who does an awesome job for us. We built a GC company, so we have a GC contractor, that works on all of our deals with us. We're training up an asset manager, right? Uh, so we're growing as a company.
Hmm.
We don't want to stay focused purely on multifamily the entire time, right? It's an awesome base to have, but I've kind of realized that the guys and gals
Yeah.
who grow the most in this space, they diversify into other asset classes. They don't do it all at once, right? Because like the dog that chases two hares catches none,
Yep.
right? So it's our plan as we grow to slowly do other stuff. And so we're looking at, getting into new developments. We're looking at getting into um, historical renovations, right? So finding buildings that, are, you know, uh, old historical buildings and
Hmm.
using tax credits and funds, and federal funds to, you know, renovate those,
Yeah. Yeah.
right? And then over time, who knows, self-storage, anything, like Nate always makes fun of, like, yeah, we'll buy marinas too, so anything that cash flows, that's interesting to us, so we'll slowly start diversifying into other asset classes, other business ventures and things like that.
Awesome. And what is your why?
Um, I so it's so funny. I think at first my why was to become some kind of, you know, high powered real estate mogul, multimillionaire. Um, but as I've kind of grown in this space, and for the last 6-7 years, as I've kind of watched other people, I've kind of realized that, having the freedom to be able to do, what you want when you want, right? So I think a lot of people come in with the idea of, giving like their family opportunities, like their families, like their why. And so is mine, right? They come in with the idea of, making tons of money or whatever. And so they get caught up though in the sexiness of always building, always building. But you have to ask for what, right? And then at what level are you going to cap that off at, right? And then are you comfortable with that? So my why is to be able to, uh, one day here soon, the next 5 or 10 years or so, is to be able to, pick one or two, maybe three projects a year, that I find interesting, and that I can work on, that will create cash flow, that I think are fun, and work on those. I will probably never retire, right? But I'm not going to ever work at I'm not going to work at this pace, when I'm 50 or 60.
Mhm.
But I still want to do that, but still have the time to, hang out with my family, to travel, to give my kids, opportunities. If they want to take them, right? That's like their choice, when they're 18, if they want to pick it or not, but that choice will be there.
Yeah.
So that's kind of like my why.
Oh, I love that. We're big on lifestyle by design. It sounds like that's kind of what you strive for, is to just
By
have that.
design. I like
Yeah,
that.
right. Yeah. We didn't. I don't know if we coined that, but I'll say we did. No, but we do use that. That's a big like a big kind of pillar of our investment philosophy, I guess you could say.
That's great.
So thanks, and you shared a ton of wisdom today. I really appreciate all the gems you dropped. If there was one piece of advice you'd want our audience to walk away with from the episode, what would that be?
Piece of wisdom, man. There's so much. I would say uh, this is not a sprint, and so you have to have grit and patience. You're gonna uh, having being the best looking person, being like the most capitalized, the most well spoken. I'm not a great speaker at all, right? But being a great speaker, those are important skills to have. But I would say that the two top skills are or traits or whatever are grit and patience. Because man, there's times where things are exciting and they're fun and you're very driven and you're very like motivated, but there's a lot of times where it's monotonous and you're frustrated and you're scared or whatever, but those but those who have the grit and the ability to take things one day at a time and build a little bit each day, those are ones to me who make it. And that's kind of how I see it. I talk to people all day every day and they're like, Eli, how did you build so much? And I'm like, dude, you are way better off than me, but they kind of lack the patience or grit, like typically, right?
I
So
love that. No, that's awesome. I totally agree. It's like one little stab at it a day. Just got to keep jabbing at it.
man, it is.
If anyone in our audience wants to learn more about you, Eli, or just follow you on your journey, where can they go to do that?
So you can email me at eli@investwithamg.com, or you can follow us on Instagram at the Atlas MF guys.
Awesome. Thanks so much for your time, Eli. And thank you everyone for tuning in today. Please make sure to share with your friends if you enjoy the show, or leave a 5-star review, and drop a comment in the section. If you're watching on YouTube, just let us know what you think. And yeah, I hope you guys have a great rest of your day. Let's get out there and take action.